the market's looking ahead to Fed Chair Jerome Powell's 2 days of congressional testimony starting tomorrow. Now, investors will be looking for any clues on the future direction of rates here after the central bank left rates unchanged at its meeting last week. For more on this, we want to bring in Jeremy Bryan, Gradient Investments Senior Portfolio Manager. Jeremy, it's great to see you here. So we heard Fed Chair Jerome Powell signal that 2 more rates are likely on the table before the end of the year. The market, though, is still only pricing in 1 more rate hike. What do you think is on the table? And why do you think the market still continues to really discount or only hear what it wants to hear when it comes to the Fed's message?
It really is because I think the pause has a little bit to do with that, right? Is that if you're that certain about that you're going to make 2 more moves, why not just make one right now? Right. And so I think they're still talking about, because they need to set the expectation that, hey, we could go higher later on. They need to set that expectation through their commentary. And I expect that to happen again in the coming weeks going forward here. But from our perspective, too, the things that they're doing are working. Leading economic indicators are coming down, which means we're slowing. Inflation is coming down. Core is a little stickier, but that also has some measurements that'll continue to come down as we go forward. So I think from my perspective, that's what the market is seeing, is why get super aggressive when you don't need to? And the fact that we just had a pause is kind of relaying that same thesis and case for them.
Speaking of your perspective, Jeremy, we want to hear your perspective on what your base case is now going forward. Are you expecting another one, given that we just had a pause, another hike?
I think we're in pause mode. I really do. If we get 1 more, I wouldn't be surprised. 2 more would be a surprise to me. And I think the market, as you all said before, I think the market would be surprised by that as well. And so, again, from my perspective, if we're talking about pausing in June, why are we going to do 2 more down the road? That was a disconnect that I really didn't understand that well, that if you're convinced that you have to do 2 more, you probably just keep going on that pace. I think from my perspective, we could definitely see 1 more. That's not going to tip things over. I think if we got to 2 and they were still talking after 1 that they had 1 or even 2 more to go, I think the market then starts to take a pause and is like, oh, we may have to take them at their word.
Jeremy, what do you think this means for the economy, for the odds that we will see a soft landing? Is that then, you think, more likely to materialize, given the fact that the economy up until this point has remained very resilient?
Mm-hmm. Yeah, a lot of it's going to depend on jobs, to be completely honest with you. That's the one thing that's held up, right, is that jobs and even wage growth has held up relatively well. It's still under inflation, but the fact that we haven't lost a lot of jobs and our wages are growing near at the level of core inflation now leads to a resilient consumer, right? You're seeing it in housing data where they're still buying, even though mortgages are higher, and they're still buying other things. Now, they've shifted from one thing to another during this time, but overall, they're still buying. And so that's where the resiliency is lied. And that's where, if that really starts to turn over aggressively, and getting to 4, even 4.5% isn't what I'm talking about. What I'm talking about is a much worse increase in the unemployment rate of that recessionary type of like 6, 7, 8%. If we start to see that, and they start to see your neighbors losing their jobs, to be completely honest with you, that's what curtails spending. And then from that perspective, that's where the difficulties would really lie.
So, Jeremy, of course, we know this is a data-dependent Fed as they've continued to reiterate. And the job market, as you mentioned, has held up, but inflation has been sticky, giving some difficulty to consumers, but not enough to really stop consumers in their tracks. Are your expectations for consumer strength to hold up through the back half of this year?
It'll moderate, but it won't fall off a cliff. Again, a lot of it's going to depend on if we start to see really significant layoffs, right? Is that the job market trends have still been even though slowing, still relatively strong overall. So from our perspective, that would be the biggest shift and change to where we would have to change what we think from an economic course perspective that we're looking at, and certainly from a market perspective and what we're looking at, is the consumer's been driving this economy here for a while. They need to, while they, we don't necessarily need them to accelerate, but they can't stop either. And so from that perspective, that's what we're paying a ton of attention to understand what the future looks like is going to be driven by jobs and the consumer.
Let's talk a little bit more about the future, Jeremy, because Morgan Stanley was out with the note today warning that investors may be in for a, quote, rude awakening when it comes to earnings. They talked about the fact that the fading fiscal support, also lower liquidity, that's expected to weigh on quarterly results in the second half of the year. When it comes to earnings, what are you expecting to see over the next 2 quarters?
Yeah. Certainly not the level of, I would call their estimates a bit draconian. Could absolutely happen, sure. But it's certainly not our base case. Our base case is for an area of kind of stabilization is what I would call it, is we've heard enough from the companies now to saying, hey, our customers are still doing what they've intended to do. Our growth profile looks like, what they're talking about the most is how many days a week they can get their employees back in the office, right? They're not talking about a massive slowdown in demand or end consumers or these kinds of things to where we don't see that big trajectory downward. So we think year over year, that's kind of how we think about things. We think year over year for 2023 is about right at this flattish to maybe slight increase to slight decline, right? I think 3% either way. But the more important component to us is as we go into the fall months, what is 2024 estimates doing? What are they changing? Because right now we're anticipating 11, 12% growth. And if we're anywhere near that, that's a good catalyst for the markets to kind of continue to propel higher as on a re-accelerating growth story, especially outside of those main industries that have been benefiting so far.
Where are you expecting to see the growth? I know you talk about the main industry, so we often talk about the Magnificent Seven, the tech sector, this AI growth that we're seeing. Where else are you expecting to see growth in terms of earnings?
I think healthcare is interesting. It tends to be, it looks like they're having a decline in earnings this year that is supposed to reaccelerate next year. I think those are companies that are actually really interesting from a perspective of stabilized growth that could reaccelerate a little bit as procedures come back more into the forefront. We heard actually United Healthcare talk about costs were rising a little bit. Obviously, that's negative for the insurers, but good for device companies and for people who do elective procedures. So I think those are areas where we could see some accelerated growth, both at the end of this year and into 2024. That's probably the area we're concentrated most. On the financial side, too, now we think regional banks still probably have estimate declines more likely than rising going forward. But outside of the regional banks, the asset managers, if we're right about the markets that, a general trend upward, they have an opportunity to not only increase from that perspective, but also increase their revenues and earnings profile as well.
Well, Jeremy, when it comes to the recent market rally that we have seen this year, certainly has dealt a blow to short sellers. They saw $120 billion in mark-to-market losses so far this year. That's according to the latest data out from S3 Partners. A lot of the gains, though, Jeremy, that we have seen since the start of the year is from just a couple of names, most heavily in the tech sector. What do you make, I guess, of that trend that we are seeing, whether or not that rally has run too far when it comes specifically to tech?
Yeah. With tech specifically, it's interesting to a certain extent is that, from the core holdings that have really propelled the market higher, those aren't really heavily shorted names, right? I don't hear a lot about people, shorting Microsoft, right? It's not a name that's heavily shorted from that perspective. So what I've been saying more along the lines is, hey, people were looking at these as a little bit of kind of where they could hide out to a certain extent. And then AI propelled that again. And then from an earnings perspective, they haven't given you any reason to sell. They keep either meeting or exceeding their numbers. And so from those top tier perspective, they're doing very well from a fundamental perspective and from an earnings perspective. And then the short selling comes on the other side is as those things go up, the short selling components, that's where you see that acceleration in some of the other names. They're saying they just have to get out of the way because those losses get painful really fast for short sellers.
Jeremy, I got to ask you, in terms of where the market is now, outside of today, we've hit a bull market. Is this kind of a head fake right now? Or do you expect this to be this straight line up, if you will, to continue?
No. We never expect linear upward to the right. So it's two different answers there in the effect of we think we are in a bull market. We think we've seen the bottom. We think September of 2022 was the bottom. But from that perspective, we are going to chop up and down, is that we don't expect this to be a straight up type of rally. Like certainly that we've seen in the last 3-4 weeks, is that it just doesn't tend to work that way over longer periods of time. Expect an area where we see a 4 or 5% correction, and even maybe a little bit worse than that. You know, we could be talking about an 8, 9, 10% correction and not even getting anywhere near where we were last September. So we've done a lot of work up front here that maybe we revert a little bit, but really from a longer term investor perspective, we would be using any of those 5 to greater than 5% corrections to getting more aggressive, because we think the long term secular trend is a little more intact.